Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
This little burgundy line here, by the way, that tells us how committed are they to those long positions. So are they accumulating new long positions, or are they starting to, they may have more long positions than short positions right now, but you can see that red line has been dipping. In fact, it's in the negative territory right now. And what that means is they're not accumulating more long positions. In fact, they're getting rid of them right now. And so that interest is dipping. So even though they're still overall more long than short, they're starting to lose a little bit of interest. So we get a little bit concerned. We start to trade more conservatively when it gets like that. But it helps to, you know, to me, it's as useful in identifying the trend as any other methodology. I mean, but of course, you could apply whatever suits your fancy. I know that, you know, a lot of traders may, I'm going to show you an example of, I'm back on the back on my chart. There we go. And I'm going to apply a parabolic SAR, which is just a, you know, that's a technician's way of, you know, it's been around for a long time. Wells Wilder created this, famous technician who also invented the RSI and the ADX and such. And the parabolic SAR, when the little dots here are above the candles, that means we're looking for bearish opportunities. When the little dots are below the candles here, we're looking for bullish opportunities. And where we wouldn't, I mean, normally there's no way we would just apply parabolic SAR or look at the COT report and say that, you know, oh, well, I'm just going to switch back and forth. So every time they say bullish, I'm going to buy long or be selling puts. And every time it says, you know, the other, then I'm just going to reverse all those trades because you'd get whipsawed. But it's a way for us to kind of establish a bit of a bias, so that we, so it's adding some rules to our trading system. So it's one of these things that we can attach a filter, and technical filters I find work pretty well. Now, you know, personally, in my experience, I love the COT report. It really is a great way to establish trend because you're kind of basically piggybacking on the momentum created by those big traders, and you know, more or less kind of tagging along with their research and analysis. But you know, whatever suits your fancy. I know traders who use crossing moving averages and things like that as well to establish a trend. So once we've got our trend established, then we can behave in the same way we would have in the equity market, where we're just kind of naturally bullish. Well, once we have something that helps us establish a trend, such as, you know, we saw that we were overall bullish on the Euro USD based on the COT report, and although we were a little cautious, then we can start to we can start to make some estimates as to, well, all right, so how conservative, how far out of the money should, you know, I want to sell puts because I'm bullish, but should I be a little bit further out of the money? Should I be, you know, if I get into a profitable position and I start feeling a little nervous, maybe a bounce off support or bounce off resistance, should I maybe sell that thing and take some profits off the table, but maybe act a little bit more conservatively this month where I can see that there's some weakness in that bullish trend? So it gives me a little bit more basis to be able to make those decisions on, so that I can not only be trying to trade where I think the market won't go, but I can decide how heavily I want to take that position. So do I want to sell really far out of the money and be conservative about when I close the trade, or do I want to be a lot more aggressive and maybe let the trade ride a little bit longer than I would otherwise? Okay, so let me pause here and answer any questions that have come up that I haven't had a chance to answer yet. Just type your questions into either the Q&A. I'm trying to watch both of them. Pete says, what point is a good rule of thumb to take profit or loss? How far out from expiration, or is there a rule of thumb? You know, if you ask a dozen traders, you get 12 different answers, Pete. Honestly, I think it really varies. And it's one of these frustrating answers that says, it just takes a little bit of experience to try to decide what's comfortable for you as to when do you take profits off the table or do you let them expire. I not by design, but I think more by default as to where I'm comfortable. I probably let a lot of my options expire worthless compared to maybe other traders who are closing them a little bit early. And I think there's reasonable a reasonable perspective for doing either one. Okay, the question that was asked before that was, can these be traded in an IRA? It depends is probably another one I'd defer to your broker. It's some IRAs, depending on who your broker is, how your IRA is set up, it's possible to trade options, but I would not say that it is the norm to be able to write options like this in an IRA, but I would talk to your broker about it and find out what you need to do to make it possible. Okay, so Robert asked, if I sell at 118, just to clarify, I get, okay, so Robert, I want to make sure I understand your question completely. So if you sold, and here what you're talking about is, whoops, I think you're talking about our little example here on the Canadian dollar when you ask about the 118. Let me clarify. When I said that we would be paid 118 per share, if you will, or $118 per contract when we sell that at the 109.50 strike price, that means you're on the hook for if you sold that, you'd get the $118 minus commissions. And if the market moved up to, let's say 110, then that's going to eat away at some of those profits. So it's not a contract value of 100K. In fact, I think the way that these work out is that the options, it's kind of like it's not completely analogous, but they're like trading a 10K contract or a mini contract in the Forex, where each point move in this case represents $1. So it'd be like a 1K contract in the, a 10K contract in the Forex. So you're not on the hook for 100K. You're on the hook for a change in the index. So imagine that you weren't trading an index here, but you were trading a stock that was worth $109. If you were to sell a call and that stock went from 109.50 to 110.50, you will have accumulated a loss for that amount. And so you think about it like that rather than trying to translate it into terms of notional value in the Forex. Is it 100K or 10K or something like that? But it's closer to it's closer to if you're looking for something, what's the notional value comparison? It's like a mini contract, 10K contract. So, hi John, what would the obligation be on that EUU 145.50 put if it was in the money at expiration? So the obligation there, Steve. I hope I answered that question before.
You did.
Okay, great. So it's just how far it is
right
in the
on
money. That's your obligation.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.